I look at everything nominally. I think you have to look at things nominally because otherwise you're going to drive yourself crazy. So I look at nominal prices. Now, I expect that the markets are going to drop. Well, my expectation is between 40 and 60% from here.
All right. So thank you all for coming on, joining us here today. I am very excited to have Kirk on. Kirk is a wealth manager with Innovative Wealth. Kirk was gracious enough to have me on his podcast, which is the Money Tree Investing podcast, a couple of weeks ago. And I thought, you know what, it would be really fascinating to have you on just to get your opinion on allocating capital here. So before we kind of get into that, I'd just like to say hello. And if you want to give a few seconds to tell everyone a little bit about yourself.
Yeah. So for those of you who don't know who I am, I'm a registered investment advisor located in the Boston area. You know, I like to pride ourselves on being different in every way in our industry, you could say. So I think just the way that we look at things is very unique, whether it's investing or operations or working with clients. We try to deconstruct the process and say, all right, what's the best way to do things? So as a firm, we really put the clients first, and when it comes to investment management, we do cool and interesting things like putting racehorses in IRAs and, buying airspace rights and tax liens inside 401k plans. Like we do cool stuff. So to me, it's a lot of fun. It's
thinking outside the box, I guess, probably can pay asymmetrically, especially these days with all the different ways to gain access, I guess, to different assets. It seems like a lot of time is spent now opening doors to things like, like you said, racehorses and the like, with not SEP IRAs, IRA LLCs, and I guess things like that.
Yeah, I mean, you mentioned asymmetric risk. I mean, that's honestly, it's one of my favorite parts about investing in alternatives is you can find some cool stuff. I mean, if you look at like, I know we're having a crypto winter, but if you look at things like Bitcoin, that's a great example of asymmetric risk, right? You can make 20 times your money, or you could lose 100% of it. Mm-hmm. And assuming there's a 50-50 chance of one or the other, I would go to the casino every day and twice on Sundays with as much money as I could borrow to get there. Because it's just, I think that's the holy grail of investing. And with alternatives, you can do that. I've seen some weird stuff, but I'll give you a quick example. If you look at tax liens, tax liens are this asset that very few people know about, but you're basically, if you think about, you own your house, you pay taxes every quarter to your municipality. And most people pay their taxes, but let's say Florida, right? A lot of people in Florida have a second home there, and maybe they don't pay their taxes on time. And so when it comes a certain time of year, I think June, where the taxes are owed, and those taxes go to fund the schools, the infrastructure. Well, because a lot of people have second homes, they don't pay their taxes right away. They might pay them 6 months later just because they didn't get around to it, right? Well, the state of Florida needs that money to run their operations. So what they do is they actually auction off these liens to investors. And you can make 18% on your money by buying these liens. And the best part about it is not the 18%. The best part about it is these liens take a superior position to every other lien holder.
Wow.
Except for the IRS, the exception of that. So banks, anyone else they owe money to, you take a superior position.
Wow.
So to me, that's a great investment. Now, there's a lot of nuance there. I'm giving you the high level, but that's an example of how alternatives can really move the needle compared to what else is out there. And there's tons of those opportunities. That's just one example.
That's so fascinating. So I have this general framework, and I guess I would start with saying that probably the only thing in investing and trading more difficult than managing your own money is managing somebody else's money. I mean, you have a whole bunch of extra stress in there, right? And in general, the wealth model, right, is to accrue assets and let compounding do its work and build returns over time, right? And so we've had this kind of interesting market over the last year where inflation is spiking and the traditional assets, i.e. stocks and bonds, are both cratering, as well as crypto. And you had commented in our conversation on your podcast earlier that you had allocated most people to cash, and you're still waiting, as far as I understand it, to return into equities. I don't know if you're planning to or not. If you can just put everyone in tax liens, that seems like a much better plan. But I was wondering if you could just sort of start with, do you agree with that general compounding model, and what made you sort of switch to cash late last year?
Yeah. So I guess here's how I'd kind of frame it. I think we all have a certain type of framework or how we see the market, right?
Mm-hmm.
We have this lens that we see the world. And I think for people who are investing their own money, you're probably more highly attuned to this. But that lens you see the world is really important.
Mm-hmm.
It could be a good lens or it could be a terrible lens, right? If you're a bad investor, it means you're looking at the world the wrong way, right? It's not you, it's just you're seeing things in a way that's not really all that accurate, right?
Mm.
But the best investors do have a good lens because their track record shows that they have a good idea of how things work, right? So their lens in the world is better. Now, if you think about the last 40 years, the interest rates peaked in 1981, depending on which rate we're talking about, anywhere between 15 and 20%. And that's where they peaked. And for the next 40 years, rates went down.
Mm.
And an enormous amount of wealth was built in that 40-year period, in large part because rates dropped. So bonds, stocks, real estate, commodities, you name it, everything, unless you were in cash, everything made money.
Mm-hmm.
Now, that's the lens that almost everybody looks at the markets with because that's all they know. They know that bonds are safe. That's my favorite one. Bonds are safe. They know that buy the dip, buy and hold, diversify will reduce risk. You think of all these like rules of thumb that you learned about investing that are supposedly true, right?
Mm-hmm.
They're what I would call a half truth. And I'll kind of paraphrase Ben Franklin, but I think he said a half truth is a big lie.
Mm.
And the problem with half truths are they're true a lot of the time, but not 100%. And because they're true most of the time, people believe them as if they're 100% true. The problem is they're not 100% true all the time. And it's that time where they're not true. That's what really messes you up. Remember when real estate always goes up?
Mm-hmm.
Everyone thought real estate always goes up.
Right.
Well, the market's melted down because that wasn't 100% true. And once people realized it, a lot of people lost big money because of that.
Mm-hmm.
So I think there are a lot of assumptions that we all make in markets. One of them might be the risk-free rate, US Treasuries, right? Risk-free rate. There's no
Mm-hmm.
risk in that. Well, there is risk. It's just really, really small,
Right.
right?
Exactly.
So I think you have to recognize where the assumptions are that you're making, and you have to acknowledge them that, okay, this is an assumption I'm making, and actively reassess. So right now, the assumptions that I made is, bonds are safe because interest rates have been dropping, but they're not dropping anymore. They're going up quite a bit, right?
Mm-hmm.
Inflation's 9.1%. It'll probably go a little bit higher from here, I'd imagine. I think the future is certainly uncertain, but I don't think rates are going to drop down to where they were, nor is inflation in the near future.
Right.
So if you look at that, right, you make those assumptions and say, all right, what's going to happen to the market? Well, Ray Dalio famously came out recently and said, cash is trash. I love that. Cash is trash. Here's a guy who's benefited from the financial system quite handedly. And if he came out and said, cash is king, everyone would pull their money from the financial system and crash the market.
Mm.
So I'm not sure he believes that,
Mm-hmm.
but he has to say that, right? Warren
Right.
Buffett says the same thing, always bet on America. There's reasons they say that, but I think reality is cash is king. Now, if you look at, I'll give you an example, 2008, a good example. So in August of 2007, we went entirely to cash, 100%, because we kind of saw the writing on the wall. I didn't know when it was going to be a problem, but to me, it seemed obvious there was a problem. And I didn't know enough to make good decisions about where to invest. So I thought cash was the safest place. I didn't short the market or anything like that because I think in crisis, I'll give you an example of a crisis that didn't work for me personally.
Mm.
But we went to cash because to me, it seemed like, all right, that's the best choice. So what happens? So from peak to trough, the market went down 58.5%. And pretty much everyone who was invested in virtually anything except for gold or cash lost money, somewhere close to 58.5%. Now, if you're in cash, you didn't just not lose 58.5%. Let's call it 50 to make the numbers easy. If the market drops 50% and you're in cash, well, you didn't lose 50%. Good for you. But you know what's better about that? Your cash just went up 100% because now that cash can buy twice as much stuff. So really, I know this is kind of a different way to look at things, but think of it this way: your cash has doubled in value because now you're able to buy twice as much as you could before. So even though the other stuff went down, you can look as cash going up. And so cash has this optionality that's baked into it that you don't have with other investments. Because in 2008, you could have said, oh, well, I'm going to get out of these bank stocks, but then you have to get into something else, but you already lost in the bank stocks. So if you're fully invested, you don't have the optionality to reallocate. Cash is what allows you to reallocate and reduce your risk. Now, I'm not advocating a portfolio of 100% in cash because that's nonsensical. But there are times where it does make sense to do that. So go ahead.
Yeah. So if I could ask you on that, how do you think about reallocating in that situation, right? Because okay, August of 2007 or late last year, you say, look, there's risk here in the market, and that risk is significant enough that it's worth going to cash, right? Because there's oftentimes tax consequences with that, or instead I just go into cash, I could just hedge this if I think it's going to be a shorter term drawdown. So what is the situation where you say, look, it's worth stepping out of the longer term plan here to go to cash because X, Y, and Z seems to be occurring?
So, and just to put a finer point on that, I don't like to look at things in a binary lens, right?
Mm-hmm.
So we're not talking about 100% cash or 0% cash. We're talking
Mm-hmm.
about some derivative thereof. So I think, when I'm looking at portfolio allocations, there's a few different ways to look at it. One is valuation, right? You could
Mm-hmm.
say, oh, things are overvalued, but of course, they could be overvalued for 10 years, right? So
Right.
that's not really a great lens. I think that's something we look at, but it's not the only thing, right? Because I think by Warren Buffett's indicator that he used for valuation, 80 to 100%. I'm sorry, 80 to 120% is the normal range. 80 being cheap, 120 being expensive. Right now, I think it was a few months ago, it was 220% in terms
Wow.
of valuation. So in regards to valuation, we were way overpriced. But you obviously could keep going higher, right? The Fed
Mm-hmm.
could put things back to 0%. Stocks could go through the roof. They can keep going higher. Like, the markets are based on the Fed right now. So I think realistically,
Yeah.
we're not talking about valuation. We're talking about what's the Fed going to do. So I think a lot of it comes down to, I like to look at the macroeconomics, and the Fed is a big part of that. But I'd say the biggest part is inflation. So if you look at inflation, that will dictate how the Fed is going to react in ways that is not a way that they want to. So they've gotten away with low interest rates, low inflation for quite a number of years, and that's been really good for the markets. But when you have 9.1% inflation, the Fed has to fight that because there's basically two outcomes. It's either hyperinflation if they do nothing, not right away, but for a few
Mm-hmm.
years, if they do nothing, they'll hit hyperinflation, or they can fight inflation, send us into a recession or a depression. They're going to try to do both, and I think they'll end up doing neither. So we'll see where that ends up. But I find that sometimes there are risks that are really just too large to ignore, and sometimes you just have to push back from the table and just say, all right, I need to hedge my exposure. Now, when I say 100% cash, we do use options as a way to manage risk in our portfolios. So I might have 5% of my portfolio exposed to the markets, which may give me the equivalent of 100% exposure to like the S&P 500, for example, and still have 95% in cash. I still have the same exposure as if I was in the markets, but I still am sitting on cash. So if the market crashes tomorrow and goes down 50%, I lose 5%. And then I'm sitting on 95% cash that I can use to go invest into something, some great value.
Right.
So I like options for that reason because it gives me that optionality
Right.
of cash. But I think, we don't live in a binary world. I think you have to look at all risks. So I do like things like gold because that's a chaos hedge, even though it'll probably go down if the markets decline. But I think I've accepted that. I do like crypto because I think there's that asymmetric risk trade that's very attractive. Beyond that, I think it really depends on market conditions. I try to keep things simple. I think, as you probably well know, the more complex it gets, the harder it is to manage.
Yeah, without a doubt, especially when you get into the options landscape, you can get very complicated very quickly, and I think oftentimes that complexity turns into it turns into a negative, right? Because the people who tend to be more complex are usually the larger, more sophisticated entities, and so you're sort of going to a gunfight with a knife, kind of. So, kind of, I think this is sort of related. One of our friends here, Bill, asked about the 60/40 portfolio, and we talked to someone named Kevin Murray, runs the Market Huddle podcast, and his sort of thought was that, the 60/40 portfolio, or that idea, right? Because we're talking about hedges a little bit here. That was something that worked in this very narrow window of time. And if you zoom out, as you sort of mentioned, you look a longer term, that 60/40 portfolio didn't really ever, bonds didn't really hedge equities all that well. And I guess a lot of people are asking now, do you think that 60/40 portfolio model is broken? A lot of people are questioning that now. And what do you think about that relationship kind of going forward?
Yeah, I think it's a good question. So let's take a step back and look at the 60/40, right? So let's look at bonds compared to stocks, because I think that's a good starting point. So historically, going earlier than 2000, right? Going back to, the 90s, the 80s, if you had a diversified portfolio, that protected you from volatility, right? So I want to make a differentiation here. There's a difference between volatility and risk. A
Mm-hmm.
diversified portfolio is really good at diversifying away your volatility. It reduces your volatility basically, and it reduces your inability to be right, right? Like we all make mistakes. So in
Mm-hmm.
some ways it's kind of makes you a little bit more idiot proof because we all make stupid mistakes. But if you look at the volatility, it protects you because when stocks go up, bonds go down. In a normal market, that is typically how things correlate, right? Now, historically, for the last 40 years, which is really when the 60/40 was used for like the last 40 years, it performed very well because you had equities, which obviously did well, bonds did well. Bonds didn't do as well as equities, although I would actually argue 30-year treasuries in 1981 actually outperformed stocks, which most people don't know. But let's just say a normal person, if you're investing in a bond portfolio, you did okay, right? Because you didn't do as well as equities, but you still held your own. And in bad times, that bond part kind of supported the equities a little bit, so you didn't lose as much. That's why it was so attractive. And I think for a lot of people, it worked. Institutions loved it. I mean, I have a lot of friends that work in institutions and they love the 60/40. The problem is what they're not looking at is the assumptions they're making. And the assumptions they're making is that it was all based on the fact that bonds were safe and that they made money every year because rates were declining. And they didn't have an environment like we have now where bonds and stocks are all going down because yields are going up or interest rates are going up,
Mm-hmm.
and that affects everything. So everything's dropping. So you're not safe. So the problem with the 60/40 is the assumptions that people are making. And the assumptions are incorrect. They were correct, right? So we talked about the paradigm shift we're going through.
Mm-hmm.
Last 40 years, we had a paradigm. It was a great paradigm. Everyone built wealth. Now, as of January of this year, that paradigm is changing. And what the outcome is in the next 5 to 10 years is obviously uncertain. But what is certain is that inflation is impacting things. Rates are going up, costs are going up. That's inevitable, right? Globalization is reversing. The engine that built our economy up till January of this year worked really well, or I should say actually pre-COVID, but it worked really well. And then all of a sudden things have changed, right? We're no longer getting the cheapest goods from around the world. Now it's more expensive because we had an efficient supply chain, but it wasn't resilient. And now companies are making it resilient, which costs more, which means your costs are going up, inflation goes up. So all these are factors that are going to come into play that are going to affect the economy. But most people are looking at the world through a lens of assumptions that they have made and have worked, and they haven't bothered to reassess those assumptions. That's like the assumption real estate always goes up, right? Until it doesn't, and then it breaks and everyone loses money. So the 60/40 was a great tool, but I think that unfortunately most of the industry doesn't look at the assumptions, and there are definitely intelligent people out there who do, but for the most part, people are asset allocators. They're looking at history. They're showing them nice, shiny charts and saying, here's what it did do. Look at how great it could do because of how well it did.
Mm-hmm.
And I think they're just making big mistakes that they're going to get themselves into trouble. And we'll find out later. Well, we don't need to. The first 6 months of the year was terrible for 60/40, just as it was for everything else.
Right.
I think it was down, well, year to date, 60/40 was down almost 14%. I mean, it's
Yeah.
not
I mean,
supposed to do that.
hammered. And I think one of the challenging things there too is a lot of people are thinking, well, we can get long volatility, right, in some kind of fashion or form, and that will hedge. And if you chose the wrong type of volatility, that didn't really pay either. So I guess that sort of harkens back to your idea that cash is king in that situation,
Right.
Even though, and this ties into a second question someone has here, is you're holding cash with inflation, 7-8%. That's obviously a penalty there over the, slightly longer term. How do you, if you're in the camp, and it sounds like you are, that inflation is going to remain elevated, how do you sort of protect against that in and amongst sort of the general sort of turmoil in the traditional assets?
That's a great question. You got a good audience here. You got some really good questions coming out.
That's great.
So here's how to think about it. Okay, let's take 4 asset classes to make things simple. Well, let's say 5, just because there's stocks, there's bonds, there's cash, there's commodities, and there's real estate. Okay, 5 asset classes.
Mm-hmm.
Each one of those you can assess for the situation, right? You can look at the market, right? We had low interest rates, low inflation. All of those did really well. Well, almost all of them. Real estate does well. Commodities didn't recently, but generally do well. Equities and bonds. Cash, cash lost 2% a year, right, to inflation. But I think the lens that people look at it with is incorrect. And let me tell you why. This year, stocks, depending on which stocks you're in, indexes are down between 20 and 30%. 30-year treasuries are down 21% in change. Commodities have done rather well. Real estate has done very poorly. Well, it depends on the real estate. Home builders have done poorly. Real estate is starting to do very poorly. But cash is neutral. Okay. So look at those 2 scenarios. Well, I think if you're looking at the assumption that we're actually talking about, which is inflation, right? There's a 9.1% drag on your portfolio. That affects all of your assets. Cash, bonds, stocks, real estate, it's all affected by 9.1%. So take all of the returns I just told you and minus 9.1%. Which one does the best? It's still cash, right? And I think this is one of those logical fallacies that people kind of fall into, and they just say, oh, well, we can't put cash because it'll depreciate in value. Compared to what?
Right.
Right. And this is the point to really take in. Inflation affects everything equally. And anybody who's good at math, what can you do when it affects everything equally? You can remove it, right? So just pretend it doesn't exist, because it's not going to impact one asset more than another. I mean, return wise, it might, but let's assume that's not the case. It affects everything equally. So whatever your return is in the asset, it's still going to be negative 9.1%. So cash is still ahead. Now, the obvious question is, yeah, but I don't want to lose 9.1%, right? So think of it this way. When I'm looking at investing, I'm looking at like 3D chess, right? You're playing, right now we're talking about a chessboard, and you're saying, all right, cash, stocks, bonds, commodities, real estate, what are they going to do? You didn't include time.
Mm-hmm.
So right now, if you're saying, well, yeah, cash will lose 9.1%. Yes, it will. And so will everything else. What about next year? What about the year after? So I'm looking at it this way. Yes, cash has lost value and everything else has. So I look at everything nominally. I think you have to look at things nominally, because otherwise you're going to drive yourself crazy. So I look at nominal prices. Now, I expect that the markets are going to drop. Well, my expectation is between 40 and 60% from here. I might from here. Yeah.
Wow.
And I'll talk about that in a minute. My estimate is probably around 47, 48%, but given the fact that we revert to the mean a lot, I'm giving it 40 to 60. So I think that's reasonable. So if that's my thesis, then cash is going to appreciate quite a bit for me. And those of you who are currency traders know cash, US dollars are already appreciating compared to other currencies. But the cash, taking that aside, the cash will appreciate compared to everything else. So I don't need to be right every single year. I could be wrong for 2 years, but if that saves me from losing 50% of my stuff, I can buy stuff 50% less and I can make 100% return on my money. Why do I care if my cash goes down 9% in a given year when inevitably I'm going to buy things cheap? Now, let me give you an example here. Go back to the 1970s, early 1970s. That period, there was about a 15, well, maybe it's 18 years, but we'll call it 15 years, right? About mid 60s to around 81. Okay. Let's say 66 to 81. Okay. You got a 15-year period there. Now, very similar in terms of what's going on now and what's going on then. Not exactly the same, but similar, right? Now, the markets from a nominal perspective bottomed in, I think it was 74. That was the lowest price for that period in 74. But the actual best time to buy was in 81, 82. That was the best time to buy. Even though the prices were a lot higher, nominally the prices were higher because the values were better then, right? But what I'm looking at is how do I protect myself from that? Back then, the drop wasn't even that big. I think it was only like 35% or something. It was really not that bad. But how do I protect myself from that drop so that I can buy things cheaper and then I can make up for that 9% on the back end because I have things cheaper. And if I buy it right, now I can sit on that asset and maybe it grows 15, 18% a year because I bought it at the right price, right? You don't make money on the sell, you make it on the buy, at least in my world. That's how I look at it.
Yeah.
So I don't really need to worry about that 9% as long as I'm not sitting in cash for the next 10 years. But frankly, if the markets are down for 10 years, then I'm not really losing anyway. I'm the same boat as everyone else. So I think that to wrap it up, to not drone on too long, the challenge people face is certainly inflation. And we do have a way to approach that. But I think the problem is people in our culture and in this world today don't have patience. And they're not patient. I mean, Jim Rogers, I love his quote. You know, he does this a lot. And they just say, well, Jim, why aren't you investing? He's like, well, I just wait till there's a pile of cash sitting in the corner of the room and I go pick it up. Meaning like he'll just sit there and cash until he sees a no-brainer approach. It's like the anaconda approach. Right. The anaconda just sits there until some unwilling beast just walks up next to it and then it attacks. Like he doesn't go chase down the animal. He just waits till he's right there. And I think it's kind of the same approach in a market like this. You have to be adaptable to the fact that if you think that your cash is losing money, you're going to be too eager to invest it too early, and you're going to lose money. So the key point to take away from this is we were in a bull market for 40 years. Now we're in a bear market, and the rule number one for bear markets is the winner is the one who loses the least. I hate to say it, but there's a lot of truth there, right?
Very, very true. So your comment here, down 40%, drew some reactions. And someone says, "Can he please explain his view on that?"
Yeah, I can. Let me dig in a little bit because I want to address that a little bit. So let me give you some perspective, okay? Because I think perspective is really important in times like this because we all lose it in the moment, right? You get heated.
So if we are down 40% from here, I just want to put this into a little bit of context. The S&P is 3950, so we're talking down to about 2,500-ish in the S&P, and that would be not terribly far from the March COVID low.
Yep. So think about So that's kind of right around the point. So if you look at COVID, right? COVID's a good example. I don't think most people realize this, but do you realize like the pre-COVID highs? We're still 15% above that.
Yes.
So even though the markets are down, we're still 15% above pre-COVID highs. And the markets were expensive then. People were talking about how, the markets are going to go down because they were way, way, way overpriced. And all the institutional people I talked to agreed. They said, yeah, there's no way it can keep going at this rate. Lo and behold, COVID happened and we're way above where that went. And I don't know how much further up percentage wise, but regardless, the market, the S&P is down 20 some odd percent. Yeah, we're still 15% above, which means we're still expensive.
Right.
So
we're at 40% at the high over that February high. So that February high in the S&P is 3,400. So it's a good 500 handles roughly below here.
Yeah. So if you drop, as you said, if you drop 40% from here, that just goes to the COVID lows. And that's assuming that that's the right price. I don't know if it is, but I think frankly during COVID, I was very actively trading there and having a lot of conversations with institutional people. And frankly, I don't know how we only went down 33%. I think, it could have gone a lot lower. But regardless, I think it was mainly due to the Fed, frankly, and that brings up a side point. But see, here's the thing. It's not hard to imagine that we go down to the COVID lows, because that was from a technical perspective, I think that's a safe number to look at. I think it brings it back to a reasonable reality when it comes to valuations. I think it probably could go a little bit lower than that, but I'm not predicting price. I'm just predicting direction, because I think at the end of the day, who knows what's going to happen. The Fed could come out and they could say, all right, we're going to lower rates again because, the economy is going to recession. That may solve the market problem, but it doesn't solve the inflation problem. So if I had one question to ask, it would be, if the Fed is backed into a corner and they had to make a decision, are we going to protect the economy or are we going to fight inflation? I'd want to know his answer, because that's really ultimately what we need to know. If they're going to fight inflation, then 40 to 60% is definitely in the cards. If they're going to protect the economy, that prognosis may happen 5 or 10 years later, but it's still going to happen. So,
and there's a very large school of thought that if you sort of just take all the leverage or all the easing, right, that came in after the COVID crash, that now this whole period is just unwinding that entire thing, right? And so I think that's why a lot of people are watching that pre-COVID February highs, just kind of like the mean reversion point, right? Because if you're just saying, look, we got to kind of undo all this stimulus that we put into the market, and that's why we get that drawdown. But as someone sort of brings it up, I think you kind of just touched on it, if we do get this 20-30% drawdown, the Fed does he say at some point, you just say, look, I know inflation is going crazy, but the wealth effect is also so large that if we lose 40-50% in the S&P in the stock market, that could potentially do more damage. So, are you saying that the Fed put may be gone as well, like permanently?
Well, nothing's permanent, right? I mean, I think the Federal Reserve is in a unique place where they're basically directing market direction, right? That's what they do nowadays. They can talk all they want about their mandates, but really what they are is they're managing the stock market, unfortunately. So I think the hard part is most people they don't really consider the importance of inflation, right? And they just think, well, the market's down, the Fed's going to bail us out, and they just draw a conclusion, right? Market's down, Fed's going to provide liquidity. And they did that in the COVID, period, and it worked, right? It worked really well. I think what a lot of people miss is they're drawing a conclusion between money printing and inflation. And I think this is one of those half truths. Technically, it's true that money printing does equal inflation. However, what they don't include is the fact that there's also deflationary forces that are fighting against that. And it's not a simple vacuum, equation held in a vacuum, right? So I remember in 2008, 9, 10, all the gold bugs, the perma bears, they came out in force and they're like, oh, the dollar's going to go to zero. There's going to be hyperinflation. They're printing a lot of money. It's going to be crazy. It's going to be chaos. I remember all those conversations. And you know what? A lot of those people were telling people to short the market. Now, if you had followed their direction, you would have lost a ton of money shorting the market all the way up. Right?
Yeah.
And what I think people miss when it comes to money printing and inflation is the fact that money printing technically equals inflation if you don't include anything else. The problem is there's so much else that's affected. So let me give you an example. If I'm the Fed and I decide I'm going to print up $100 quadrillion, which dwarfs how much money's actually out there, right? So if I printed that up and said, all right, I'm going to take all this money and I'm going to stick it in a bank vault over here. I'm going to lock the door. Do we have inflation? No, right? Because the money's not doing anything. Whether you created it or whether it's not created doesn't matter because no one sees it, right? Money printing does not equal inflation. Money printing plus that money circulating in our economy, that's what causes inflation. So if you look at the amount of money printed, it's gone through the roof. Yet if you look at the velocity of money, it's gone through the floor. And it peaked out in the late 90s, and in COVID it dropped close to 20%. And I haven't looked at it in the last month, but it's still really low, which means they can print all the money they want. It's not moving the needle, because unless that money is circulating, it means that money printing doesn't equal inflation. The equation I use is basically, the amount of money, the money stock times the velocity of money. If you make that chart, which we do have, you can see it's a lot more obvious the direction of where that's going. And all the Federal Reserve is doing and printing money is filling in a hole that the recession created, right? So they're just basically filling a gap and trying to keep the economy sputtering along. So it's not going to cause inflation until the velocity of money really takes off. The inflation's really coming from the supply chain.
Right.
And everyone I talk to says 3 to 5 years before that's really fixed.
Yeah, there doesn't seem to be any even interest in trying to aggressively fix that. And then you have the ESG policies and the like that seem to be exacerbating things. So,
I've talked to a lot of people about this, many who are involved in the supply chain, their companies. And frankly, initially I was surprised that nobody came up with a solution of how to fix it, until I talked to a few people and realized what the problem really is. Like, the government doesn't know how to fix it. That's not their job, right? You'd think the private sector would fix it, but the problem is we're reversing globalization, right? Like,
yes.
we outsourced everything to China, and now that's reversing, but all the manufacturing is in China. So where are you going to send it? Well, you have to build manufacturing facilities to put it somewhere else. Mexico, Canada, Vietnam, wherever, even the US. You have to build new facilities. That takes 3 to 5 years. So
Yeah.
all of that regionalization, that resilience that's being built into the system that'll cost you more money at the end of the day, all of that takes time. And until those are built, we're stuck with some of these issues. And that doesn't mean prices are going down. So if anyone thinks prices are going to go down, they're never going to go down to the prices we're at. Well, I say never is a long time, but for a long time, because that's not how they're being constructed. They're being constructed to be resilient, regionalized supply chains. So that, like I said, that costs more, but that just means earnings drop. All these things eventually happen. But yeah, I think it's important to recognize where the inflation is coming from, because if you don't understand where it's coming from, then you'll be misguided in your assessment of how to invest around that.
Yeah. So this is kind of interesting here. I was poking around while we were talking for a price earnings chart, and I found one. And to be fair, I haven't ever checked this site out before, but on the screen here, this is just kind of interesting. This presents the price earnings in the S&P 500 over the long term, right? And it says that the average price earnings of the S&P is 19.8. Now, if you look at where the S&P would have to trade for the price to earnings ratio to be back at 19.8, it says on this chart that we'd have to be roughly down around $2,500, maybe a little bit higher than that. So that is the 40% decline there if we're just talking getting back to an average valuation. So that's pretty interesting.
Yeah, and that's the average, right? And things revert to the mean, which mean that's why I said 40 to 60. I think 40 is the lighter end. You could definitely go down to 60. I think part of the problem is when things unravel, everything unravels. And for a good example of this, if you don't remember 2008, I know you do, but maybe the listeners don't, is, look at the crypto winter right now.
Mm-hmm.
When things unravel, when it goes down 70% or more, depending on the coin, all of a sudden, all these business models start to implode because they're based on things going up, right? Like Celsius filing for bankruptcy. I have clients who did that against my advice, I might add. And I've told them, I said, this is a precarious position.
Mm-hmm.
I know nothing about the company, about their stability. I'm not making any claims. I said, I'm just looking at their model. Their model breaks if it declines. And they're like, yeah, I know, but I'll be good. I'm like, all right, I just don't say I didn't warn you. And so I think, Bernie Madoff, people found out 2008, Sanford, same thing. Like, all these models break when the market declines, which leads to more decline, right? Because people freak out, they take their money out because they want safety, they take it out of the system, which makes it worse. It's like the bank runs in the Great Depression. People get scared, they take all their money out, which makes it worse, right?
Right.
It's like the news saying, "Oh, there's a run on food." Like, great, you just caused a run on food,
Yeah. And that
So
that is probably, to me, one of the most interesting aspects of this drawdown is that it's really been a cold winter in the bond market more so than equities. I mean, yeah, if you bought ARK or something like that, you're getting hurt, but the S&P's not doing really all that bad. And we obviously watch options here. The VIX didn't really accelerate all that much, and so I think it's hard to say that there was any kind of a real washout, or there was never really that moment of panic really at all. And I think that's kind of universally felt here, at least in the equity space. And so, for those people who are waiting for that, blood in the streets kind of moment to call a bottom, I think it definitely feels like you have not gotten that yet, so far in this drawdown.
well, I think you and I talked about this on my show before, but the market's really just not pricing in the expectations of things getting worse,
Hmm.
right? I mean, if you looked at I was looking at the chart the other day, the Fed funds futures curve, and it looks like January of 2000, the Fed funds rate will go up until January 2023, and then it'll start declining. Really? Like, that's the expectations? To me, that seems a little bit rosy. So maybe, and I think this is the part that is interesting to me, and this gets into your comment about the VIX, is that people are not expecting things to get worse.
Mm-hmm.
I mean, some people are, but they're not pricing it that way. They're people and this gets into bear markets and why they're so challenging, right? Everybody's lens is from the last 40 years. And that's how they're looking at the market, like, oh, this is just a dip. We can just buy in here and it's just a dip. It'll go back up. Maybe it will. I don't know. I can't tell the future, but people are not pricing in something worse because the economy is still good. I don't know if these people understand the real estate market, but when you go to 2% up to 6.5% in a matter of like 2 months, that's not good for real estate. And yet people are not pricing in an Armageddon. I mean, real estate's certainly not being priced very well right now, but it's certainly not Armageddon. But if you have mortgage rates go up to 10%, I, you know,
Yeah.
bar the door. I don't know how you're going to get people out fast enough.
Yeah.
That's a bad scenario. I'm not saying it's going to happen, but I think you have to like run it through your mind as what if. It's definitely possible, if not probable, but it's something you have to run through your own filter of what would I do if this happened. And I just
Right.
don't see people pricing that in.
And the velocity, about with mortgages is also interesting because if you locked in, I mean, mortgage applications just dropped to a 22-year low. That was on Bloomberg. I just thought was quite interesting. And if you have locked in one of these 2.8% mortgages, it's going to be really hard to dislodge you from that, right? To say, let's go buy another house at all-time highs with a 6% or whatever the 30-year is, at this moment. So I'm with you on this housing, a big retracement in housing values.
Yeah, it's interesting. I mean, it's an interesting, puzzle. I think that we're all looking at, and obviously we don't know the future, and we have to acknowledge that. But I think it's the willingness to suspend, rational thought. I think is, to me, it's fascinating. Like the markets in the U.S. have been able to do that for decades. As bad as things get, people are always willing to come in and buy it and push it up. And eventually they do change, but not knowing where that turn is hard. Like 2009, the markets got worse for the next few years, even though the economy got worse for the next few years, but the markets kept going up. So
Mm-hmm.
it's always hard to predict what the outcome is going to be, because you're balancing the market, which is future expectations versus reality. And right now the markets are down and the economy is still going strong, even though the Fed's trying to push us into recession.
Yeah. Yeah.
So that's the thing that I find interesting, is the Fed's trying to push us into recession, which means they're going to raise interest rates because that's the only way they get us there. And yet people aren't expecting rates to go up. So
Right, you can get that kind of twin pain, and I have the chart of Germany up on here, and there's a lot of other, the dollar's quite strong now, and so I think a lot of what is helping to hold this up is a general allocation into equities or just cash kind of flowing into the U.S., which is arguably kind of the most attractive place right at the moment, because Europe obviously has a whole different situation in terms of energy and the geopolitical side, and Asia seems to be struggling in various in various ways. So you have the strong dollar, and on the German, I have the German index fund up here, the iShares, and this thing is threatening to go back to. I mean, it's quite a bit higher still than the March low, but it is quite a bit lower than the U.S. So it's taking a lot more pain now. And same with bonds. I mean, I think if you know that interest rates are going to go higher, you can make an argument that maybe that means cash flows into equities. So I do think that some of this is just technical flows as opposed to necessarily valuation metrics, just in terms of how well the S&P is holding up.
Yeah. I saw, I was looking at your questions here. I have a comment for Travis, actually, quite a question about the 401k, because we came up with something really interesting. He said, how do you protect a 401k from what's to come? In a practical sense, you don't. I mean, cash is really your only option.
Right.
However, I will say this, if you have money outside your 401k, you can synthetically protect yourself. So as an example, let's say you're 100% invested in the S&P in your 401k, you can synthetically protect yourself with options on the outside. So combined together, you have one big pot of money, but separately, one will do well and the other will not.
Right.
So that is one way to protect yourself, because I know 401ks are generally limited with the options that you have.
Yeah.
But that's one way we do it for clients, is we create synthetic setups, because it's really, I mean, most plans are terrible.
Yeah.
They really are.
Yeah.
The options are terrible. So
anyway. In that case, you got 100,000 in your 401k, you could say, okay, I'm going to buy some puts just in my brokerage account, allocate whatever X amount of dollars to puts to protect the 401k.
Yep. Now, if you have your own company, this is what we do. If you have your own company and you have your own 401k, now you can have fun, because now you can put any sort of investments in your 401k, like, real estate, or not that I'm advocating real estate. I'm actually highly against it right now, but you can invest in anything in your 401k, especially if you got your own company. And that's, like I said, what we do. But there are other options. You're not limited to mutual funds if you're in control of your own company. If you're another company, then you're pretty much relegated to whatever they give you. So
right. Travis asks again, how much per 100,000? There's a great book by, oh shoot, I'm of course drawing a blank on his name. Mark Spitznagel. He covers this. If you just look in Amazon, he's got 2 books. I think both cover this idea of, he's in general proponent of a 1% allocation to the downside. He gets a little more specific in there. I think that's a good book to check out in terms of how much you pay for insurance, or how much insurance did you buy for, let's say, $100,000. And so Travis, check that out.
Yeah, it's an interesting, I've gone back and forth on this for a while on the preference of how you allocate the option space. Do you do, like, at the money? Do you do in the money? And I think in part the way I've looked at it is, it depends on the market.
Yeah.
It depends what the market's doing. Is the market really overvalued? I would probably make a different decision than if it was really undervalued. Like, that's how I've looked at it, rightly or wrongly. But
I mean, to that point, not to get too deep in the option side of things here, but if you bought out of the money puts here, you made some money just because, if the market got down to the strike of your put, right? But a lot of people buy put options hoping that implied vol goes crazy, right? That you're making money from convexity. And there's a lot of folks who feel that didn't really pay off despite the drawdowns here, by and large. So, what you buy does have a big impact on how well, how well of a hedge it provides. And that's been, one of the trickier aspects, I think, of protecting yourself so far this year. So, Kirk, we're coming up to the top of the hour here. Do I still have you? Hello?
I'm still here.
Oh, yep. Okay. Sorry about that.
Yeah, I'm here.
Went quiet for a second here.
Yep.
So, Kirk, we're coming up to the top of the hour here. I can't thank you enough for taking to walk us through a lot of these views. It's really interesting, and I'd love to have conversations with people like yourself that are sort of outside of the options arena, particularly when, this idea of allocating and timing investments and things like that is pertinent to all of us. So if you can take another minute, just let people know how they can get in touch with you. That'd be most appreciated.
Yeah, absolutely. And once again, I really appreciate you having me on your show here, Brent. This has been a lot of fun for me. Yeah, if you want to find more about me, I'm pretty easy to find. We do a weekly show every week on Money Tree Investing Podcast at the URL, moneytreepodcast.com. You can find me with our investment advisory solutions. You can find me at innovativewealth.com. That I do all the writing. So if you want to read some of our stuff, we're actually coming up with a lot of inflation content in the next few weeks. It's just taken us a while to research and come up with it.
Yeah.
But yeah, we do a lot of interesting stuff. We're in the interesting business. We we try to do everything differently and think outside the box. And to me, that's a lot of fun, whether it's advanced tax planning or investments. For me, it's like, hey, I get to view the world a little bit differently today because I got to learn about this new cool thing that I didn't know about yesterday. So yeah, that's where you can find more about me. And yeah, so this is good. Thanks for
Yeah,
having me
that,
on.
that thinking, that outside the box mentality, I think is particularly important these days, given the return in these traditional assets. So thank you again, and we look forward to having you back.
All right. Thanks again, Brent.